Let's talk about a multi-billion-dollar safety net for huge companies, one that you're paying for without even realizing it. We're diving into government guarantees today, and we're going to ask, is this promise of security really a safety net, or is it a hidden cost for you, the taxpayer?
Okay, just think about this for a second. Imagine you co-sign a loan for a friend who's, let's just say, not exactly great with their money. You'd be pretty nervous, right? Because you know that if they bail, that debt is suddenly all on you. It's a massive risk.
Now, what if we blew that scenario up to a massive national scale, where the government, funded by your tax money, is the one co-signing for these enormous corporations, some of which are known to be losing money year after year? That's the real question we're getting into.
All right, so let's start with the promise itself. In this first section, we're going to unpack exactly how state governments become this financial backstop for some really big and often really risky companies. The main tool they use for this is something called a guarantee fee. Now, in theory, this fee is supposed to be like an insurance payment. It's money collected to pay taxpayers back for the huge financial risk the government is taking on. It's the price for making that promise. And who's on the receiving end of these guarantees? Well, a lot of the time, they're Public Sector Undertakings, or PSUs. You can think of them as massive state-owned companies, things like power utilities, that in many cases have a long track record of losing money. They are basically our friend with a history of not paying bills.
So this all leads to a super important question. What is the price of this promise? I mean, how much does the government actually charge to take on what could be billions in high-risk debt?
Seriously, let's think about that. If you were shouldering that kind of risk, you'd want some serious compensation, right? So what's the magic number the government has landed on? And you know what? This isn't just a hypothetical. We can actually find the answer written right into law. Let's take a look at a real example from the Meghalaya Government Guarantees Act. It spells out the exact price. 0.5%. That is the annual fee. We're talking half a penny for every single dollar of risk. Just let that sink in for a second. Okay, and this is where it gets really, really wild. Look at this chart. The state is charging somewhere between 0.5% and 1%. But if that same company tried to get a guarantee on the open market, a commercial lender would charge them 5 to 10%, and that's if they'd even agree to take on the risk at all. This huge gap, this chasm between the government's price and the market's price, that's the real heart of the story here. So whenever you see a gap that massive, you've got to start asking yourself what's really going on. Is this what it appears to be? The source material we're drawing from puts it perfectly with this question. When the fee is so completely disconnected from the actual risk, can you even call it a fee anymore? Or is it really just a subsidy in disguise, a backdoor gift from the taxpayer to a struggling company? Let's just be crystal clear on what this all means. The state is charging a tiny, tiny fee to take on a risk that the private market would either price way, way higher or more likely just walk away from completely. So the government is essentially stepping in where the market won't, and it's the taxpayer left absorbing all the potential fallout.
And this kind of arrangement, where the state just shields these companies from risk, well, it creates a classic economic problem, and it has some pretty serious hidden consequences. It's a concept called moral hazard, but it's actually pretty simple. If you protect someone from the consequences of their actions, they're probably going to act a bit more, well, recklessly, right? I mean, if you have a giant safety net, you're a lot more likely to try walking a tightrope without any practice.
And you can see exactly how this cycle plays out. First, the state offers that dirt cheap guarantee. Second, because they have that safety net, the PSU goes out and borrows way more money than it otherwise could, often without making the tough financial changes it needs to. And third, if it all goes sideways and the company defaults, guess who's left holding the bag? The taxpayer.
And look, don't mistake this for some dusty old economic theory. The Reserve Bank of India, the country's central bank, is flagging this issue all the time. They're constantly warning states that the volume of these guarantees is ballooning into an unsustainable risk.
So, what can we do about all this? Well, that brings us to our final section. We're going to arm you with the tools to become your own fiscal watchdog. Here are 3 really powerful questions you can ask your own government. First, compare the rates. What's the real dollar value of this subsidy? Second, check for compliance. Are they even collecting that tiny fee they charge? And third, identify any defaulters. Have taxpayers already had to bail one of these companies out recently? And you know, that second question is so incredibly important, because what the research often uncovers is that not only is the fee ridiculously small, but sometimes the financially strapped PSU doesn't even pay it. So the taxpayer is shouldering all of this risk for, quite literally, nothing in return.
Which leaves us with this final, really critical question. We know the government is there to guarantee the loans for these big corporations. But when it all goes wrong, who is there to guarantee the taxpayer?